Hello, everyone. My name is Oles. Some of you have probably already seen me. We have done these events in the past, and they have been, from our perspective, so successful that we're launching this brand new series of podcasts, which are called InsideX. I'll be your host for today, and we're tackling a very important question that every founder today has on their mind, and that's about funding. What does it really take to get funding in 2025? Things have changed, times have changed, the rules have changed, and I'm joined today by three wonderful experts who are in the trenches day to day, and they offered kindly to share their knowledge and expertise on the topic and maybe help some of you founders make those crucial decisions, which will help you get funded by the end of the day. So please join me in welcoming these guys. As
Hi everyone.
there we
Hey,
go.
good morning, good afternoon.
Hi guys, thank you very much for joining. I'm joined here today by David from RockawayX. He's the investment manager there. He'll be bringing the VC perspective. We're also joined by Ondrej from Moonhill Capital. He's the co-founder there, and he will give us more of the fund strategy lens and the allocator. And Jimmy, who's the portfolio management director and the head of Accelerator at Cipholio Ventures, he's gonna offer us also the perspective on the funds of funds. Gentlemen, if you could just give me a one-liner about your companies slash investors, that will help maybe illustrate a little bit more into what you guys do. Can we start with Ondrej, perhaps?
Sure. So I'm with Moonhill Capital, co-founded Moonhill Capital. It's early stage VC fund, and we basically invest into all sorts of projects that are in here in the crypto space, not limited by any sector. And I think we backed some of the interesting projects in the past, like Nillion, Ionet, My Network, Mo Network, and many others. So just a brief overview.
Thank you. David?
Hi, I'm David. I'm an investment manager at RockawayX, and RockawayX is a 2 billion AUM Web3 investment firm, investing in mostly seed stages, usually between 1 and 3 million. We also provide liquidity to DeFi and infra projects, run validators of 60 different networks, as well as operating solvers. A couple of investments we made in the past. We were part of the Solana seed round back in 2018. We invested in Camino, Squads, and many leading projects, mostly in the Solana ecosystem.
Thank you. Jimmy?
So hi everyone, this is Jimmy. So I'm portfolio management director at Cipholio Ventures. Cipholio is the investment arm of a crypto exchange called Bitmart. We represent the exchange, invest, and incubate those early stage projects. Entered the industry back in 2021. So help a lot of early stage teams with product positioning, exchange listing, and also liquidity strategies.
Great. Thank you guys for the intro. I have known you for years, all of you. And so for me, generally, it's very interesting to really hear your perspective on how things have changed. So maybe let's just start with a very quick warm up. And I would like you to describe it in very short form, perhaps a sentence or two. How has the fundraising landscape in 2025 changed compared to, let's say, 2021? It doesn't really matter the time frame. I think you guys know what I mean by that. So maybe David, if we can start with you.
Sure, happy to start on this one. So, like from my perspective, I joined VC investments and RockawayX back in 2020, and the market was completely different. So there were way fewer projects. There was way more capital, so it was way easier to fundraise for startups. Just to put things into perspective, there were around 12 billion invested capital in just first quarter in 2021. So that was like an incredible time, right? And since then, it has changed significantly. The market matured mostly, and it's way harder to fundraise right now. I think it's mostly, like comparing maybe the market from 2024 to 2025. In 2024, I think the markets were mostly and the fundraising environment was mostly driven on narrative. Um, there were all these sorts of different narratives where people and investors jumped into them and wanted to fund the projects there. Whereas now I think it's slowly but surely moving to be a fundamental driven market, and we've seen that mostly throughout the early months of 2025 up until now.
Thank you. Jimmy, for you, how did it change? What changed?
So, in my observation, definitely like things are getting more challenging. So a lot of founders like putting a lot of efforts like to raise money, but the actual outcomes, I wouldn't say that's very strong. So I know there's a lot of fundraising outreach compared with before. So way more like emails, like DAX, like linking messages than before. So, but the quality of the projects, I wouldn't say it's like matched like compared with previously. So we saw quite a few teams. We still haven't figured out like who their real users are and what problems are they are solving. And also at the same time, we see a lot of inflated user numbers, like either on chance or other like metrics. That's I wouldn't say stand up to like serious check.
Okay. Ondrej, what about you?
Yeah, I think that the landscape changed a lot. I think the major change was since the US presidential election, as we've seen like significant shift in the policy making in the US, and with more clarity that brought like the Genius Act, Clarity Act, Stable Act. We are now as well seeing institutional investors that are dipping their toes into the space. We've seen BlackRock, OneEck, and others profiting basically from the record inflows into their crypto-related instruments. There are as well some new trends like DATs now that are attracting quite big sums of capital. So from my point of view, now we've seen in the last 1 year, I would say, like steady growth in the amounts of funded capital. But I think that what is necessary to mention as well is that the overall sums are high, but on the other hand, they are more concentrated. So in total, there are less projects being funded. So I think that says basically that's some sign of maturity, that investors now are more cautious of where they allocate the capital. So as it used to be before into 2021, spray and pray method, I don't think it's a longer valid one if you want to be successful in this cycle.
Understood. Ondrej, if we stay with you and maybe talk a little bit more about the capital allocation. I mean, from your seat, obviously the macroeconomic conditions have changed, the interest rates, liquidity, the general appetite for risk, etc., etc. How have these literally influenced the way you guys allocate capital at Moonhill, if at all? But of course, probably.
Yeah. I would say that there's been a change in what we were like focused on more of the sectors. So we've seen that now the sectors that are getting hot are the ones that are basically focused on the institutional ones. So for example, RWAs are interesting choices, I would say. So there's been that shift because, for example, into 2021, there's been more projects like into gaming, but that was not getting that much traction. And as mentioned, now with more of the institutions coming, the focus changed as well. So I would say that the change is basically in the focus of where we invest into what sectors in the crypto space.
Okay, understood. And when speaking of macroeconomic conditions as well, and maybe just regulations at the same time, David, I know you guys are pretty global, right? But still, you guys are based in Europe to an extent, or you at least you have started in Europe. Things like Mika in Europe or maybe SEC pressures in the US, do they change how you think about structuring investments, or is it just business as usual for you?
Not really, right? So like from our perspective, the regulatory certainty that those regulatory acts bring to the market is actually like welcome because it brings clarity, right? It brings clarity for the investors as well as for the startups. And that's mostly welcome for everyone, right? On the other hand, there is a big difference is how the two continents, Europe and US, have approached regulatory environment. From our perspective, or maybe my perspective, is that the MiCA regulatory environment is a little bit conservative as compared to the US regulatory environment and it a little bit maybe chokes the startup environment in Europe, mostly because it's basically quite costly to be compliant, right? I've heard stories that startups needed to answer like 150 questions for to the basically regulators, and there was just one round of questions, and there were like multiple of those. So I think it's a little bit challenging for the startups. It for sure increases the barrier to entry for startups to enter the European markets. So maybe it will be like established companies, profitable companies that would benefit or that will benefit from the regulatory environment in Europe. But for us, I think it's mostly about seeing whether the startups understand the regulatory environment, whether they could walk in it, and how they're budgeting and approaching it. I understand that maybe some startups would prefer to have kind of like regulatory free for all, but I don't think that is sustainable and long-term healthy for the crypto and Web3 environment in Europe.
Understood. Jimmy, from your fund of funds perspective, what are you hearing from investors? Are LPs pulling back, or are they just shifting their strategies to like fit the new reality? How do you see things from your point of view?
So LPs, they are still deploying, but I would say they start to like get more diversified in terms of their portfolio landscape. So we do see a lot of the companies, they start to turn into like, I would say, more like Web2 focus. So like for example, the AI or like traditional stock markets, they start to look into that a little bit more. In terms of the crypto landscape, I think they are still willing to explore if there would be any sort of like a real like use case, like mass adoption parts. So these are still, I would say, narrative that the traditional LPs are looking into.
Okay. So guys, I mean, let's look and zoom in a little bit on more how investors think about opportunities in 2025, which I think is very important for our listeners or viewers. David, maybe let me start with you here. How have your due diligence standards evolved over the past couple of years? What are the red flags nowadays that you absolutely won't ignore anymore, that maybe in the past were kind of okayed? We know the landscape changed, right? So have you seen any developments there from that side?
Yeah, so on our side, like the DD standards were quite high since we started, and we have not funded like many projects that were quite hyped because we haven't seen a way how they could turn the business into like a profitable, sustainable one. So I think that is something we were always like focusing. We need to see a way for a startup to be sustainable, to generate money, to generate revenue in a big market, right? Which is, I think, like one of the most important things. The DD is mostly done from the lead investor, which acts as a signaling for the other investors that follow in the rounds. So, startups should ideally secure a lead investor as soon as possible, because that helps a lot in the further fundraising. But I think it's all about but kind of like sustainability and revenue generation potential, right? Which I think in the past was not always the case in the space.
Sometimes, I mean, we've seen people were basically selling white papers in the past, right? So it's not that case anymore. Ondrej, when you guys are evaluating Web3 projects, what carries more weight for you nowadays? Is it the tokenomics design or real user traction, and it may be something else?
Yeah, so for us, basically in the current market, I think the traction in users and revenues is significantly more important than the tokenomic design. We've seen that in the previous cycles, the quality of the project's tokenomics was often like the primary metric for the fundraising, and then investors were willing to bet on complex, highly speculative models, and they were just hoping for return on the token appreciation alone. And basically, this is something that led to oversaturation of projects with flawless white papers, but no real world utility or users. So today, due diligence has changed. So investors are no longer impressed by these sort of sophisticated token models. Instead, I think the focus has moved to more like verifiable business fundamentals. So question, I think, is no longer like what could this token do, but more like what is the token doing right now. And I want to see some proof of a market and market product fit, basically. So I think that like perfect example of this success can be platforms like Pump.fun and Hype, because basically these platforms became incredibly popular, and they were widely used even before they had a token, and people loved the product and basically the community around it. And then the token, when it came, it was simply just like cherry on the top of that, so I think that it allowed basically the community to participate in the value that they had already helped to create. So I think that this shows that the true value in building is something actually building something that people will love to use. So tokenomics is still important, and bad design can basically sink even great product. But I think that now we see it as a tool to support a proven business model, not as a replacement for one.
Yeah, maybe I would add here one thing, right? Like that traction. We've seen that traction has been faked multiple or many times in the past, and it is super important for investors to distinguish between traction that is genuine versus the one that is hype driven because of expectation for some airdrop. And in the past, it was sometimes challenging to distinguish between these two. But as long as there's some, if the traction is coming from a genuine usage, and people stay even after the airdrop, that's what investors want to see.
Is that the
Yeah,
only way
that's
how you prove that genuine traction? Is there anything else that you might give out to us as a cookbook or recipe for how do you actually bring the proof that the traction is actually valid and real and not just
Yeah, so this depends on the type of the startups or the business model, right? In B2B startups, it's mostly big names that are looking to purchase the product or service, that are willing to, pay for it in the early stages or be the design partner or sign some LOIs and so on. So that for sure helps to prove some tractions. In the B2C space, it's mostly about users, right? But as long as they're paying for it without the immediate expectation of an airdrop, that is the clearest sign for genuine traction.
Mm-hmm.
Yeah,
Jimmy,
but,
yeah, go ahead,
sorry,
Ondrej.
just to add to this, I think it's even now you basically can sort of purchase TVL. You can boost users or like wallets connected to the protocol. So it's really hard to distinguish like what is the real usage and what is like artificial usage. So I think that's a big issue right now as well, like when doing due diligence.
So it's still a little bit of a shoot in the dark type of approach when considering those. But I guess that's the nature of the business that we are in, isn't it?
It is. It is.
It is. Jimmy, for you maybe it's a little bit different, right? You're evaluating funds rather than startups directly on many occasions, correct? So do you also look at the due diligence process that the GPs that you invest in? Like what convinces you that the fund manager will actually manage risk properly? Is there anything like that?
So I would say trust is the most important thing. So if we don't share like trust connections with those founders, it's almost impossible for us to like verify their like previous track records, and we probably did not invest. But I would like to add in a few comments regarding how to evaluate like a project. So especially on regarding data part, right? So of course, like we know, like they have on-chain data, so this can be fights like I would say proof like easily. But we also need to look into their social and other like Web2 data. So a lot of times you see a project, they say they have a lot of followers, they have a large community. But if you actually look into that, if they have a lot of inflated users, it's actually easy to catch. Like there's like real users, their activities, like you can tell it's real, right? And also there are some like other Web2 like metrics. For example, their website like traffic. A lot of times it's no very easy like to inflate. So if you cross-check all those metrics and compare with those group projects as a benchmark, a lot of times you can tell the difference.
Understood. And if we shift, maybe this is a question to all of you guys, because I think everyone has an opinion here. If we shift a little bit, maybe from the metrics, how about spotting the founders themselves, right? So let's talk about the people. How do you tell a difference between someone who's just chasing hype or someone that actually is building something that will endure the cycles? Is this even something that you guys look at, presumably? David, what about you?
So what worked for me is seeing and meeting the founder in person. That always helps, right? It's not always possible due to the global nature of our business. But most of the founders travel, if they're fundraising, they're traveling to conferences. So meeting the person in person actually is actually very great because you can assess many different things. Like whether they understand the business, whether they have what they have achieved in the past, right? You're asking like all these questions, and then after a while, you get a clearer picture on who are you dealing with. It's a lot of soft skills that one needs to kind of possess to understand and to evaluate the founders, but I think it's mostly based on either the conversations or as well as with evaluating what they have achieved until the point that you're meeting them.
Jimmy, do you have any cookbook recipe into how to look into a person? I mean, presumably you still run into those situations where you have to analyze the team, the founders, etc. Is there any approach that you take, or maybe?
So yeah, I agree with Debbie. Like meet in person, I would say is definitely very important. So I would say it's kind of the art part instead of science part of the evaluation criteria. So I would say if the person have like a lot of passions regarding like his like efforts, like a lot of times we see like founders like they know they are doing, they talk very well, but you don't see a lot of passion in the eyes. So it's hard to tell how to find the passion, but if you like get to know this person well, you can tell.
Mm-hmm. And Ondrej, for you, I mean, knowing you as from a personal perspective, would you still consider founders who are hype driven, but if they still can execute, is that something that you would evaluate?
Yeah. I think it's important as well. But for me, for example, like interesting lesson learned from like the previous cycle or this investment cycle was basically about trusting my gut. That I found out that it's important because, for example, I've experienced when I felt that the founder wasn't like fully committed or was more focused on raising the next round rather than building the product. But that get ignored because that feeling because the numbers were looking good, for example. And in one case, founder was actively fundraising for a new L1 while he was simultaneously raising for a current project. And that's something that I found out by chance, So uh, this isn't just an isolated incident. We've seen like co-founders selling their bags OTC, leaving the projects day after the TGE, and so now for me, if I see like any discrepancy in a founder's story or any sign of this sort of mercenary mindset, it's for me now like immediate deal breaker.
Hmm. I think this is very interesting, guys. I mean, if we let's bring this closer for a little bit to the founders who are listening or watching. David, if I'm a founder right now who's raising, what's the number one mistake that kills a deal for you that I would make?
I would say it's the cold outreach, right? Like if I just get pinged by someone over email, over LinkedIn, and that I've never met because the founder received or got the email. Like usually VC investors don't open those emails at all because that doesn't show big competency. So for a founder, I would always suggest to get a warm intro. Ideally, maybe from other founders that he or she has connected with previously, and that always helps, right? So I think like cold outreach is for sure something that is a red flag for me. But I think also it's sometimes the prolonged foundation, or sorry, fundraising, right? That founders are going through. So we have seen or many startups fundraising for maybe 9 months, right? And that is not the right way to do it. Usually, I would suggest founders to assign themselves or get or allocate themselves like 3 months sprint to do the fundraising, focus on it fully, and if that doesn't work out during this period, there's probably something wrong, and they should get back to the drawing board. Maybe think some things more through, or get more traction, or so on.
Hmm.
So like
That's
that is also something that is bad.
I think that's a very, very important topic that you kind of just touched on. Jimmy, for you, like in today's market, would you say that it's smarter for founders to raise smaller, more frequent rounds, just do like a safer bet, or do they, or do you actually prefer maybe when someone goes bigger and does more decisive raises?
It really depends on the project. Say if the founder has strong fundraising ability and they have backing from major investors, I think then going for like a large like milestone round, usually I think that's better. It saves them a lot of energy because but if the projects act a lot of actually like they struggle to raise, so they have to go with those multiple like smaller rounds. So it's basically a realistic option for them. Like
Mm,
even it's not the ideal situation. So of course, like larger rounds is better, but you have to like
mm,
make compromise a lot of times.
understood. What about you? What would you recommend to founders? Smaller rounds, more frequent, or not?
Yeah, I think for me it makes more sense to aim for the bigger milestones. Basically, the data are showing that concentration of the capital is at the top end of the market. So while the overall funding amounts are high, the number of deals is lower, as I mentioned before. So I think it's because investors are now writing like larger checks to projects that have really clear path to the market, that they have like very verifiable revenue, experienced team. So I think that the strategy to raise a little, then raise a little more, is risky, and then as well it can lead basically to project running out of money before they're able to
Mm.
deliver anything. So instead, I think that to be a successful founder in 225 and beyond, you should prove the traction with some small initial round, then basically aim for some major milestone, even if it's like product launch, gaining some significant user base, or creating the revenue stream, and then use this basically as a catalyst for the larger, like more final round.
I've had an interesting statement from unnamed investors in the last year or so, where they said, and these guys have pretty valuable traction on the market, but what I've heard is you're better off just trying and go for it. It's just as hard to raise $500,000 as it is 1.2 million, for example. So you might just as well just go and shoot for the moon with the 1.2 million straight away. Is this a statement that you guys would agree with, or does it really negate what
Yeah,
you?
yeah. So from my perspective, fundraising takes time, right? And it takes a lot of effort. So founders should probably like focus more on making sure that this effort pays off, and get some, money that is that will secure the development time for at least a year, or maybe probably even larger, like 2 years, right? So as long as they could achieve that, it's worth fundraising. Obviously, like if there's no capital to be that they can spend, right? It's important for them to fundraise something for that could sustain their business. But like the goal should be at least 1.5 to 2 years of product development before the next fundraise, because fundraising is distracting and it takes time and effort.
Mm. Do you guys agree with David, or do you have a different view?
Yeah, I think that it makes sense, because as David mentioned, for the founders, I've seen myself, and we are fundraising for the fund as well. It takes a lot of effort, and basically you can't focus on anything else. So makes sense, to have the investors lined up before you start actually raising, have some commitments, and then it's much easier, to come to some additional investors and saying, okay, we just opened up the round and we are already 50% filled. So it creates like this FOMO, and it helps you as well to close much faster. So I think that's a good approach.
Mm.
Yeah, I agree. No additional
Yeah.
comment on this.
Let's guys, let's talk a little bit more about where capital is actually flowing. Jimmy, maybe let's, since you're already warmed up from your last sentence, from your perspective, which sectors in Web3 are overfunded right now, and where do you actually see undervalued opportunities?
So I do have a contrarian view here. So I feel like the RWA and stablecoin like related projects a little bit overheated right now. So we have seen quite a few like in the previous approaches. So especially like some of the projects, I think they have a really like big like I would say big dreams, but they don't really have enough I would say backing, like capital backing, and also the execution ability to fulfill that I would say like outlook. So yeah, that's the part I would feel a little bit like overfunded at this point. On the other hand, I would say like meaningful AI products, I would say they are still they are still undervalued. So previously we have seen a lot of AI products. They are just like AI agents, but disguised in maybe like as a meme, I would say. So those type of projects, they have a hype. Like it's about almost a year, I would say, like compared like starting from last cycle. But the AI product with real use case, that's something we'd love to see.
Ondra, what about you?
For me, the overfunded sector, I would mention the infrastructure projects because for a long time already, I think that this is oversaturated sector. There is so many L1s and other infrastructure projects that are just looking that have solutions looking for a problem basically, and I don't think that many investors are longer willing to fund this sort of vaporware or projects that can't really demonstrate a clear utility or adoption. And next one that I would probably mention is DAT, digital asset treasuries. Uh, I've seen that's picking up a lot at the moment, but I think that the space has become crowded with these projects that basically are just mimicking a strategy without any unique value proposition. And as well, I think that they will face significant challenges once the market will start trending down. So for me, these are two that I would mention probably.
David, your turn.
Yeah, I would actually agree with Ondra here quite a lot. So I think the infrastructure um, was like sector was quite overfunded over the past couple of years. We've seen that some well-funded projects have not delivered what was probably expected off of them. Then we've seen so many DATs on the markets right now, and we'll see how this will play out. I think it all depends on how much yield those DATs will generate, and that would sustain the premium. But let's see also how traditional investors will trade those, because we've seen that volumes on some of the DATs is very low, so it is almost like impossible for the investors to exit from the DATs. But let's see how this will play out over the next couple months and quarters. On our side, like what we're mostly interested in and where we see the clearest product market fit is yield on chain, stable coins, trading venues, RWAs. All of these sectors, we see there's still a lot of opportunities, and are sectors that are mostly very much of interest for us.
David, if we stay a little bit longer with you, Jimmy did mention a big buzzword right now, and that's AI/crypto. For you, is it just hype, or do you see genuine value drivers there?
Yeah, so I think it is mostly hype. So we have seen some projects that like Virtuals that was doing quite well, were maybe earlier this year, towards the end of the last year. But I think there is yet to be seen a big innovative AI cross crypto product or startup that will bring something new to the market. So as of now, am of the opinion that it's mostly more hype than real substance, but I'm happy to be proven wrong.
And Jimmy, if we zoom out, we just spoke with David about the capital flows, maybe in the future, and some. If we zoom out again to your like LP seat, where do you see the capital flow moving in the next 12 to 18 months? It doesn't really matter about the time frame. I think you understand what I mean by the question. So, are you guys also, or not you? Sorry, are LPs like favoring specific strategies, or maybe moving capital into even different geographies? Is that a thing that for you to consider?
Um, Geography-wise, I wouldn't say they're gonna change that much. The U.S., of course, like because the regulation gets more clear, I think more and more money will go back to U.S., which we have already seen like this year. I think this trend will continue. So yeah, let's think geography wise. In terms of sector, so for us, we are more like sector agnostic. So I agree some sectors are a little bit hit. Like we see some narrative as almost dead, like GameFi is almost dead. But love to see like more and more like exciting like trends coming up. I think like capital markets, this is the way capital market works. If a new trend is coming up and start to get attraction from those like top like funds, like things a lot of other investors will follow.
Okay. And Ondra, if you take your sphere of predictions and about capital flows, is there anything you might want to share with us?
You mean like geographically wise?
It doesn't have to be geographically. So what I mean, just where do you see the capital flow in the next X amount of months? Is there a topic which you want to highlight or?
Like to me, what I think that is interesting is basically the apps. I think that the most exciting opportunities are basically the applications that will be intuitive and that can attract like Web2 users who will not even know that they are in Web3. So for me, projects like Polymarket, now Football.fun are like good examples because they are focused on creating like great user experience, and then the blockchain is just like this seamless piece of the technology stack, and then the token basically isn't the point there, the product is. So as I mentioned before, that should be the goal for everyone, and I think that's something that we need basically to bring more users from the traditional Web2 to Web3 space via these like Trojan horses that will be the apps.
Okay. And Jimmy, when we if we like look around and from your again perspective, are LPs asking for different reporting and metrics, or maybe just the transparency? Did it change to the bull market years? How is that like reshaping your expectations for GPs,
Um,
if
yes,
at all?
yeah, they do prefer, I would say, like more transparency. But I would say most of the funds they doing already like good in terms of transparency. But it's more about I would say like the depth of communication. So a lot of like I would say funds, they say okay, I give you a quarterly report that should be enough. But actually, a lot of investors, especially fund investors, they may invest to it's not just to get like a quarter report. They prefer like an in-depth communication with the fund manager. They want to pick up their brands, like to see that what the market is about, like to trend in the next few months. So if you not only provides like say reporting, but also provides good in-person communication with your LPs, it's definitely helpful.
Okay. If we maybe roll back a little bit, gentlemen, and because I think we're slowly running out of time, and judging by experience, I don't want to dive too deep into different topics right now. But if we can just summarize a little bit the founder aspect. So many things have been said right now today. So if you could give one piece of advice for founders who are raising in 2025, what would it be? Try to keep it to really just one piece of advice. David, can we start with you maybe?
Yeah, so I think it's important for the founders to sell themselves, and because the earlier they're looking for fundraising, so basically the earlier the stage of the startup, it is more about the founder. If the startup is mature, then investors look more into the numbers and so on. But for early stage startups, it's very important about the team and about the founders. So it is very important for them to sell themselves.
Ondra?
Yeah, I would say that the founders should focus on building a real business, not to focus like to a crypto project. And I think that for this, they should prioritize basically like three things: to have product market fit, clear path to revenue, and as well to be legally compliant.
And Jimmy, for you?
I would say make sure to bring your real, like verifiable data, like to investors. So if you put together all your metrics, like investors should make sense of it. So yeah, that should be it.
Guys, I've heard a couple of, I would say, polarizing and interesting statements, and I haven't told you about those before because I really want to hear your genuine reaction right now. Let's be honest, right? So I've heard many times that VCs do not even know how to properly evaluate tokenomics, and then they're just backing founders that they like. Is there validity to that statement, or do you think this is a pure fabrication? David, what do you think?
No, I think it's valid, right? Like tokenomics can change significantly, right? The founder you cannot change easily, and mostly if the founder leaves the startup, it's over, or it's very much a different startup later. So like tokenomics can change, even the business model can change. So you don't know what the token, what role will the token play down the line when it's time to launch it. Right. So I think there's for sure some truth to the statement.
Mm. How do the rest feel about this, Jimmy?
I agree. Yeah, because agreeing like tokenomics can change easily actually a lot of times. But now if you the trust of the investor, especially if you have any like share experience previously, that wouldn't change much. So trust is always more important than other like metrics.
I guess
Yeah,
Ondra, knowing you, it's the same.
Definitely, I agree, but sometimes you could even see like tokenomics that aren't from the very beginning not the ideal ones. So definitely agree that the founder itself is more important than the tokenomics. But then sometimes you can spot in the very beginning that the tokenomic could be designed the wrong way. So but that's basically something that VCs should do. Basically, give some sort of advices to the founders. So that's still something that's fixable.
And if we talk about the people's aspect of leading a VC or just being in it from the investor side, could you guys tell us honestly how much of your decision is actually gut feeling or gut instinct versus actual spreadsheets and models? Is there a percentage ratio perhaps you would add to it, or is there any other relationship that you think plays because why I'm even asking this question, by just listening to you just now with the tokenomics and just how you perceive the founders, etc., I have a feeling that despite you guys being big players in your areas, right, making those big decisions, etc., there is still this human element in it, i.e., the gut feeling. Is this a present attribute when making those decisions on the investments?
Yeah, so 100%. So from my perspective, unless the founder is excellent, we don't look much deeper into the startup, right? And only if the founder is great and we want to back him, then we dig deeper into all the other aspects of the of the startup and go deeper into code, understand what is understand basically the all the details about the project. The startup needs to be also in a big market and have some clear path to profitability and like working business model, at least on paper, right? But like I would say the founder is the most important thing.
Yeah, definitely agree. As I mentioned before, I wasn't always following my gut feeling, and then it proves to be something that I should have done. So definitely agree with David as well.
Yeah, agree. Yeah. We actually have an investment like committee. Like we need to actually bring all those information like to the table for them to review. So gut feeling, of course, play a role over there, but you need to like prove your case. You need to a lot of evidence other than like gut feeling.
I love that we are extracting emotions from investors right now. This is something that we don't see on conferences that often. So if we talk about a little bit more about the personal aspect and just the emotions and the human element in it, what's a mistake you guys have personally made in the last 2 years? Maybe a deal that you regret passing on, or maybe one that you wish you haven't done, but obviously let's keep it respectful. But is there a situation like that? Because I think we just keep talking about the tips and tricks and do's and not do's for the founders. I'm sure there's more than enough from the investor aspect to also talk about topics like that. So is there a mistake that you have personally done in the last 2 years? David, what about you? I think you seem like you're revved up to answer that.
Look, so VC is all about hitting, couple or one big returner for the VC fund. So obviously there will be many failed investments. So that is part of the game, right? So it is expected that many of the startups will eventually fail to fundraise further rounds and maybe run out of the money. So, that is always that is part of the game. As per a mistake, I don't have a concrete example for that, because we always, when we did or decided to finance the startup, we were convinced that it's a good bet for us to make at that point in time. From hindsight, one is always sees it at a different picture, or sees it from a different angle, and would probably decide differently. But you cannot change the past, right? So at the points of the decisions, I think we haven't made any significant big mistakes.
Do you guys feel the same? Very political answer. I love that.
Very
Yeah,
similar. Yeah.
definitely. There is. I don't think that there is anything with higher risk than investing into early stage projects. So definitely, if you want to be on the VC side, you need to be prepared that 90% of your investments will fail. But of course, when it actually happens, it can be a bit difficult to process it. But yeah, I wouldn't as well probably say that we made some mistake, that there was something that we overlooked. In a couple of the cases, when there was some fail, it was something that would be not impossible, but probably really hard to discover, whether it was the founder that did some things that I wouldn't expect for the founder to do. I don't want to judge if it was intentional or unintentional, but yeah, I would probably did not change any of the decisions that we've made.
Jimmy, have you ever done any mistakes you regret, or is everything going perfect?
Yeah, there are cases like we invest in projects, and they rush to launch a token, and then it's after a few months, it's ready to jump the ship and go to another project and start everything started. So and still they ask money from us. We're like, okay, we shouldn't invest
Speaking
at the beginning.
speaking of tokens, by the way, Jimmy, would you agree with the statement that 90% of crypto projects do not even deserve a token or should not have one in place, or are you of a different opinion?
They should have a token, but a lot of times they, I would say, they don't care about the token value in the long run. They use the token as a subsidy, to their marketing or user operation. So a lot of times they don't care about the long term value of the token. I think that's the bigger problem. They
Okay,
should
how
have.
would you address the long-term value, if I may ask?
I think founders should keep that in mind. You shouldn't
Okay.
just, if you need money, you shouldn't just dump the token and get and get the funds. You should really think about how the token's value can help you brand. Either it's your project's brand or your personal brand in your own right.
Understood.
But a lot of
Understood.
people don't really have that mindset.
Gentlemen, as we slowly wrap things up, presumably you guys see hundreds of thousands of pitch decks for X amount of time. What's the one slide, or maybe in a pitch deck, or maybe one topic that almost nobody gets right, but instantly also tells you if the founder knows their stuff or don't? Is there anything like this?
Like for me, basically, when there is this page in the pitch deck that always shows like the numbers, what the market, what's the market potential, etc. Usually, it's to me the slide that's completely unnecessary. It doesn't say anything about your project at all. So that's something I would probably leave out of the pitch deck.
100% agree.
Yes.
I love
Yeah,
that you all agree on this.
completely agree. Also, the hockey sticks are always, I'm taking those with a big grain of salt.
Okay, understood. Gentlemen, thank you very much for joining today's podcast. One last question that is a little bit of anecdotal that I have to all of you. If you could share your weirdest moments or most memorable pitch that you've had while working from the investor side. Do you have one?
A difficult one. Doesn't come to mind at the moment.
So I guess investing is not really that funny, right? We're talking serious business. I think judging from today, very valuable points have been shared by all of you. We run through the val cards, which I think I don't want to push you guys to summarize your thoughts again. So we'll just leave it at that. Again, thank you very much for joining today's discussion. For all of our listeners and viewers, this will be recorded, and I will also be happy to give you an option to ask the speakers or experts today directly. So if you want to do that, then please reach out to me on my Telegram, and I will filter out those messages and connect you with the relevant person if you really need an intro or not. Guys, I appreciate you very much. Is there anything you would like to share? One last tip to the founders that you haven't perhaps maybe right now came to your mind? David, is there anything you would like to?
No, I think we have said most of it or all of it actually. So, if you're interested in working with RockawayX, just reach out to us or reach out to me, and I'm happy to look into it and like discuss what we can do.
Yeah,
Jimmy,
same
any
here,
last
basically.
words?
Yeah, if you need help in listing, market making, or like marketing in Asian market, definitely reach out to us.
Perfect, guys. So again, thank you very much for joining. The session will be recorded. Ask your questions away, and we will be back with a series and some other topics again. And gentlemen, I hope to see you soon, whether in person or remotely. Thank you very much for joining.
Thank you.
Thanks,
Bye.
Les.
Having
Take care.
us.
Bye bye.